So there is a point in time that you're able to say, welcome to our first, our second, our third, our fourth. At somewhere in the teens, I've lost count in terms of our webinar series. I'm excited to get to have this conversation. More importantly, I'm excited to talk about FedNow, but even more importantly, I'm excited to talk about with the folks who are joining me today, who are with me today. So let me just formally welcome everybody to the monthly American Fintech Council webinar series. We're excited every month to explore different ways in which we can inform our membership in the wider fintech and regulatory audience about the latest and greatest happenings and or controversies in the world of fintech. And this month, I should say, we're going to be exploring the world of FedNow and real-time payments and the ups and the downs and the benefits and the progress and so many of the great things that are going on in this space. And so with that, I think a round of introductions are in order. Tim, I'm going to start with you, mostly because you, I think, have the nicest virtual backdrop or real backdrop, unclear, but I think it's fantastic. And so we're starting with you.
Well, it is a fake plant in the back, so if that means anything. Hello, everyone. My name is Tim Boike. I'm with the Federal Reserve Financial Services Group. Technically, I'm with the Federal Reserve Bank out of Chicago, but I work across the system with all 12 of the banks, as well as the Board of Governors on payments-related activities. So I've been with the Fed about 6 years now. I have responsibilities for much of the FedNow engagement and outreach to a lot of the non-banks, the fintech sectors, the trade groups, things like that. Prior to coming to the Federal Reserve, I was 18 years with Wells Fargo and then another 6-7 years with US Bank Corp selling treasury services.
So you absolutely know the banking system inside and out. Got it. Jason, we're going to kick it to you.
Jason Henrichs, I'm the CEO of Alloy Labs. We are a consortium of community and mid-sized banks that work together to make sure they remain relevant as the world continues to evolve. Payments are a key area for us based on some insights we developed as a group. We did a payments deep dive and actually went and created a payments utility company that helps stitch together the various ecosystems and payment rails that are available. It is, I believe, the only bank-owned payment rail for community banks, built by community banks for community banks, in the likes of how the Clearinghouse or, say, Early Warning came together with the biggest banks. These are the small and mid-sized banks. We work very closely with the Fed across a number of things, since we are, the prime market that FedNow was developed for.
Excellent. Thank you so much. Aaron.
Hi, thanks for having me. My name is Aaron Kouhoupt. I'm a partner at the law firm of McGlinchey Stafford. We're a nationwide law firm, and I work in the consumer financial services regulatory team. Do all kinds of things relating to primarily fintechs on the lending, deposit, payment side, bank partnership agreements, and all the fun stuff that comes with non-depository institutions, but also represent some depository institutions. And my background actually was in-house, so I was at both banks and fintechs prior to coming outside. So I've kind of seen it on the inside from both perspectives. So.
Amazing. Excellent. I'm excited for the conversation again. And for those who don't know, my name is Phil Goldfeder. I'm the CEO of the American Fintech Council, and so excited you could be here with us. I had the unique opportunity last November. I got to moderate a panel together with Mark Gould, who runs FedNow and as CEO of FedNow over at Federal Reserve Financial Services. I'm getting it right, Tim. It'll take me a little bit longer, but I'm almost there. And it was an amazing conversation. It was an amazing conversation because number one, Mark is fantastic at what he does and is super engaging. But number two is the progress that we saw, but not just the progress. It was what was accomplished, from point of when it started to where we were at the time. And I will be honest, in my previous world, I was not a critic of FedNow, but I was not a believer that it could be done and be delivered on in the time frame in which it was suggested. and ultimately whether it would be successful. And Mark, to his credit and to the team's credit, proved me wrong. And so, Tim, for those who didn't have who weren't at the summit, firstly, I'll just shameless plug, the next year's summit is November 19th. Tim, for those who weren't at the summit, can you talk through just the basics, right? What was the initial hope? What was the strategy? What was the timeline? If you can, give everybody an overview of what is FedNow and how did it evolve from where it started to where it is today?
Yeah, no, happy to. I think a lot of people know that the Federal Reserve has a long-standing role as a payment operator in the U.S. It was granted that authority by Congress a number of years ago, many years ago. And our goal really hasn't wavered or changed at all. That is to enable safe and efficient instant payments for all communities and users within those communities around the country. The Fed made and announced its decision to build an RTGS, real-time gross settlement solution, back in 2019. And if you've been following along, and if you know the Fed, that decision wasn't made in a vacuum. It was made after a lot of deliberation. Deliberation with a lot of central banking peers around the world. We had a chance to talk to them about how they've implemented their own solutions. But also, we authored and socialized a strategic white paper, convened numerous task forces, and then we also actually did submit, I think, 3 requests for comment through the Federal Register notice, where we received a large number of letters response back, all with the majority support around it. So that was all really kind of before we decided to build the network itself. As for the formation of our strategy, really kind of leading up to the launch and the current state, we really haven't changed our approach at all. You talked to Mark, and I'm sure Mark really kind of talked a little bit more about the decision to build. But also, as we launch this network as well, we really have kind of 3 perspectives or 3 endpoints in terms of how we look at strategy. One, from a product functionality perspective. We launched with our minimal viable product, our MVP, and that release of that product is really capable of handling instant transactions on a base or a core basis, right? So, basic clearing and settlement. Our vision there then is to really continually enhance that product set, improve on that MVP solution, and really enable more functionality that really coincides with user demand and use case complexity as the financial institutions and their customers really tend to get more comfortable with it. As far as endpoint growth, we're aggressively signing up financial institutions left and right, all shapes, all sizes as well. And those authorized, certified service enablers too, that are bringing on to our network a number of financial institutions. So think of core platform providers that smaller financial institutions might outsource to, those that I think probably Jason's a bit more akin to and working with as well. Last I saw, that network reach included roughly 47 of the 50 states across the country, including DC. So we're very happy with where we're expanding. We're not just expanding in some of the largest cities, but we are managing to get beyond some of the large cities and into small town America as well. Roughly 9 months ago, we started with 35 banks, I think 15 or so core platform providers. That number has exceeded 700 today. So our onboarding pipeline continues to be strong as well. So we're actually very bullish with kind of where we are with that. And then one last thing I'll mention from a usage perspective, we're doing a large amount of evangelism. We think that's needed. That was something that we heard loud and clear from our central banking peers that have come before us. So we do a lot of speaking at conferences, do webinars like this. We're also producing a ton of educational content and working with trade groups to kind of get that word out there. Trade groups that represent payroll, brokerage, real estate, online marketplaces as well. And then probably most critical and most important, we're heavily engaging with a lot of those banks and credit unions and their customers, right, directly, talking to them about opportunities where accelerators like Alloy Labs can really add a ton of value there and start to drive some of that usage. So again, that strategy around its endpoint reach, its product functionality, and it's certainly creating awareness and encouraging action.
Well, thank you. Jason, he did my job for me. We're gonna flip it right to you, right? And we're gonna get into the weeds a bit, right? So now let's just go back and provide some historical context from an industry perspective, right? You've been at the helm of Alloy Labs and running a great organization for quite a bit. What was the expectation? What was the thought? Give me your historical context for our audience.
Well, we have several of the beta customers for FedNow and several of the beta customers from RTP. And what's interesting is to say, oh, wait a second, if we had RTP, why did we need, FedNow, and where does this play? And I think one of the biggest parts that has come out and was very clear was the expectation and the hope from a lot of the smaller institutions is a leveling of the playing field, right? I think that it is no mystery to most banks that payments are increasingly important because they are the primary touch point, the most frequent touch point for most of your customers, whether that be commercial or retail. The payments and the movement of money is becoming much more important, and the traditional infrastructure providers just aren't keeping up, not even with the Venmos of the world. But if you look broadly, just this idea of having embedded finance and capabilities to the movement of money to conduct commerce and to do other things is so important. In the old method, where the action, the thing I'm trying to accomplish, and the rails by which the money moves were divorced, that's actually changing. And if the community banks can't provide these embedded experiences and be able to build unique experiences, they will be left behind.
So like a lot of items we talk about in fintech, right? It's providing opportunities for traditional banks to compete, right? And competition is not bad. And we're going to talk about RTP in a moment. But competition is not bad. And so you thought it was, do you think it was sort of welcomed at the time? And how has that shifted to where you are today?
It is welcomed at the time. I would say there was hope that it would be more of a silver bullet. And knowing, the Fed's point of view on this, it was never intended to, knowing it could not be the silver bullet, right? It does not have the interface and the other pieces by mandate, and how it was developed, that it, you just take it and voila. And the sad truth is no technology really ever really serves as the silver bullet. I like to, within the payments world, let's pick on Pop Money or AccuLink, right? Since they're no longer with us, they're easy to point out. If you ask banks, how successful was Pop Money for you or AccuLink, they're all like, oh, it was a horrible failure. It's like, what'd you do with it? Well, we put it on our website. What did you expect us to do, right? It was in our mobile and online banking. It's like, okay, but you did nothing to add value other than a button, nor did you educate the customer more than the awareness of said button on what it could do and how it could improve their life. And this is where I think Tim's point around education and engagement, not just with the bank as an endpoint, but the customer as the user, that's why it's essential, right? And I think for FedNow and RTP, it's only going to be successful for these banks if they take a step back and they say, strategically, where do payments fit for us and for the individual customer segments? And how do we actually use this in a way that adds value to the customers? Peter Davey, who used to head innovation at the Clearinghouse, leads Alloy's payments business. He has this fabulous setup. He's like, if you look at how banks and financial institutions view payments, it's ACH, same day ACH, wire, RTP, FedNow send, RTP send, RTP receive, right? All of these things, right, in my minutia around what it means. But if you ask a customer, a payment is a payment is a payment. And so if we look at the rails as ahead, is what we wrap around it. It's the capturing of data, the using of data, ease of use is important, but ease of use towards what end, right? There's all these problems we need to solve for customers that the rail adds value to them.
Amazing. Aaron, okay, so they've opened a lot of doors here for you to walk into. But again, sort of thinking about And again, Aaron McGlinchey has been a partner for a long time, and happy you could be here. But sort of your experience, again, if you can, just sort of taking a step back and providing some historical context from either your clients or your experience in terms of the need for faster payments, the need for something like FedNow.
Yeah, no, I'm happy to be here. The beauty of going third is I can just summarize what the two of them said because they hit it really well. I think what Jason said is really important about, how the size of the institution and how important payments might be to their, future goals and their landscape. Really, that answer to that question varies tremendously, right? I mean, I know some smaller financial institutions are perfectly happy to not really go here or to partner with non-depositories who might be able to offer the service for them more economically or in different sort of contexts. And there's other that do want to make it a core part of their business. And to Jason's point, and also Tim to an extent, leveling the playing field with FedNow so that it's accessible to institutions that maybe were relying on non-depositories to do some of these things because they simply couldn't get into the market in an efficient way. And so, those banks now have an opportunity to kind of step back and say, do we want to continue to do that, or is there now an opportunity for us to do it ourselves? And I think it really does vary. I think some are excited about the ability to offer it themselves, and some are perfectly comfortable kind of sitting back and continuing to partner with people that do it. A lot of it has to do with the resources. A lot of it has to do with what the bank has in store for compliance obligations and, where they're going to do a lot of that, where they're going to put the resources behind it. But, I think the answer really does, amongst the smaller banks in particular, just depend on where they want to go with payments, as Jason said.
And so let me ask you this. Do you think how much of this from your expertise is going to become just an education process? Meaning to what Tim said earlier is that we're the big part of the success is not just the back end program. It's making sure people are aware of what it is, how it works, and the best ways to utilize it. How much do you think that's going to play into getting to changing the comfortability with people embracing it?
From a consumer perspective or from the financial institution perspective?
Both.
I think from the consumer's perspective, I couldn't say it better. A payment is a payment, right? I don't know that the consumer needs to be overly comfortable. I think that they are comfortable with instant payments, and they're utilizing instant payments everywhere.
Aaron, I was prepared to object. So I was going to jump in. I'm like, I don't think the customer is going to notice. So yes, file an agreement.
Well, hold on. I'm gonna, and again, hold on. In the interest of making this as conversational as possible, do you think there is a consumer that prefers using Zelle to Venmo?
I think it's a matter of personal preference, to be completely honest. I mean, just recently, I was at a restaurant, and the restaurant, their payment platform was down. And the waiter came over to me and gave me his personal Zelle, with the manager coming over to say, this is how we're going to accept all the bills today, or you're going to pay this waiter who is going to set aside all tax implications that might have occurred from this. But for an entire evening, this waiter took in payments because the payment system was down. And, I do this for a living, so I hesitated for quite a bit before I agreed to do it. But looking around, everybody whipped their phone out and nobody even blinked an eye. The waiter only had Zelle. So if you didn't have Zelle, you fundamentally couldn't do what they were asking you to do. My kids are old enough to have accounts, and they have different things. And, the two that are old enough both use a different platform. And I really think that it's a personal preference. But I think to your first point, Phil, and I don't know that the average consumer necessarily understands the difference between the two of those, as far as, what they're getting, maybe how it's funded. They understand that you're putting money into a wallet first, but for the most part, they know that it's a way for me to pay Jason.
Jason?
So I agree with Aaron that they don't recognize that it is in large part either what they got first or like what they've been forced to use based on who in their ecosystem uses what. Now, granted, as a payments nerd, I have every payments app from the time I was there because I wanted to see the onboarding, etc. But it drives me bonkers when I have to cross platforms, or heaven forbid, this is the one that kills me all the time, is it's a group, but Tim uses, call it Zelle, and Aaron uses, Venmo, and I want to split the, drinks we had together at happy hour to nerd out on payments. And I have to like Zelle one, Venmo the other. I even have to ask Phil, I'm like, what do you even use? This cross-platform piece in these walled gardens, I think, are going to actually hold back the industry until we as an industry find a way to begin to solve that. And Tim, sorry I accused you of being a Zelle user.
I am a Zelle user. I'm a big Zelle user. So,
Okay, so
yeah,
Tim, Tim, I'd like for you to dig in there. I mean, again, talk to me about now. Use that. I would use that as a foundation for the value prop, right? So now, where do you fit in? Kind of talk to me. What do you think?
Yeah, well, so I am both a Venmo and Zelle user. Admittedly, I'm probably more akin to Zelle. Still have my Wells Fargo checking accounts and everything, so that's probably why I use it a bit more. But a lot of it, I think it's almost generational. It's almost brand awareness as well. I certainly know what my balance is in Venmo, so if I can afford to pay my lunch bill or my dinner bill, I'll probably use Venmo if I can. If not, then Zelle is probably my second choice too. So, I think I'm wide open with that. Beyond that, I don't know if there's a big distinguishing factor with the consumer and what payment mechanism that they're going to use.
Okay, so I'm going to stay with you, Tim, for a minute, because RTP was invoked a few times. FedNow came in, RTP already existed. I know there was a thought that RTP was for the bigger banks or biggest banks to kind of implement that kind of system. I don't need you to talk about them. I don't want to turn this into that, but tell me how do you approach that conversation? What makes FedNow different? How do you think about how your growth has been with that sort of hanging over you from when you started?
Yeah, no, I've spoken with the folks from RTP quite a bit on stage. I know them really well, and actually I used to work with the clearinghouse quite a bit when I was with Wells Fargo. So I think they've got a fantastic solution. I think it works really well. The big knock with RTP is that they just haven't gone downstream enough, to small town America, to some of those community banks, and have offered that solution here over the last, 7 years that they've been in market. So I like to think that the marketplace is certainly big enough and capable of housing two viable and healthy operators. We're seeing a lot of interest, and I know RTP is seeing a lot of interest from the smaller financial institutions, yet we're seeing a lot of interest from the larger financial institutions. So I think that that cross-pollination of being a part of the networks, I think is good. I think it's healthy, and that optionality goes well for the consumer.
Well, and back to Aaron's point, I don't think they're even going to notice, but I do think RTP will be good for some applications, FedNow for others. And it's the value delivered on top of it is what's going to lead the customer to choose, not knowing what the rail was, but they're choosing based on some other value metrics.
Aaron, do you have an opinion on sort of, and I don't need you to opine on the differences, but just generally in terms of how it's being perceived and maybe what you talk to your clients about?
I don't think there's a difference in the way it's being perceived. I think that it's very use case heavy as to which, when one service is going to work better than the other. I know we're not going to get in, there are some legal differences on the back end, but, they both do a very similar function. And I don't know that from a consumer's perspective, I don't know that they're really thinking about, right? I mean, their primary thoughts are, what's the value I'm getting? What's it going to cost me? is there something being passed to me from a cost perspective to do this payment? I think Jason makes a great point, and there still is a weakness here, right? How much can you cross platforms to somebody that the problem we had in the restaurant where, they only accepted Zelle, which, again, I wanted to stay back after to talk to the waiter about how he got himself comfortable taking all these payments. Total side note, I guess.
I'm disappointed that you didn't, by the way, because that'd be
Yeah.
a great
know.
next step in the story.
I know, but I didn't. I just left and monitored my account for fraud, which we'll talk about later. But no, it was I don't know that the consumers are really thinking much beyond what's it going to cost, how quickly does it get there, how safe is it? Outside of those three things, I think it's more on the financial institutions where the difference is in the use cases as to why the FI might decide to implement one, both, neither. I think it's really where it's a little bit more of the rubber meeting the road than it is the consumer necessarily.
Well, great. That puts us right back to you, Tim. Like, obviously, you talked about the very impressive numbers, the amount of banks that have come on board. Is this where you expected to be at this stage of growth? Are you happy with it? Are you disappointed in it? Or you want to see, even more? How do you guys think that FedNow is doing to this stage, and why is that? Why are banks sort of embracing it the way they are?
Sure. Yeah. No, yeah, I think as far as endpoint growth is concerned, we're hitting our goals each quarter. Our pipeline supports our annual onboarding goals. So, unless there's a major disruption in the industry and things are getting interrupted, I don't envision us, falling short this year with those endpoint goals. As far as network volumes, I think every network provider would love to see additional volumes, greater growth from where they stand. 9 months in, our volume is modest. I'll be the first to admit that, as early adopting financial institutions are building some of that awareness with their respective customers. And they're migrating beyond this, initial receive-only capability. But we're quite aware that for network usage to grow, we need to expand the number of send-enabled financial institutions. And honestly, I'm actually very encouraged, mainly for three reasons. First, we're seeing a large concentration of our biggest financial institution network senders starting to opening up their FedNow platforms to their corporate customers. By them doing so, those volumes are starting to come back into or come to the FedNow endpoints. So we're really bullish on that. Second, in addition to these large senders, we're seeing more and more use cases being enabled through a whole new set of downstream, more regional, large community bank financial institutions as well. Those that are, to Aaron's point, trying to become a little bit more prominent in the payment space and trying to make some headway there. And then finally, those large certified service providers that I mentioned a bit earlier, those that are onboarding a number of the 700 that are in production with us today, they're now introducing send functionality as well. So we're actually going to see an increase in some of the network volumes, and we're very happy with quite honestly, with the diversity of the network as well.
As well as sort of, as you said, the geographic coverage. I mean, you're literally picking up, banks in nearly every state. Jason, I just had the privilege of meeting with your members at your annual meeting. This was obviously a hot topic amongst, banks that are participating and banks that aren't participating. What are you hearing? What are some of the things that you're thinking about or your members are thinking about?
I mean, we're spending a lot of time amongst the banks. There's some that are in purely because they know they need to begin experimentation, and they were willing to sign up to that and say, we're not going to have it all figured out up front. I would say, call that 9 of our banks are kind of in the category, and give us the other 99 are in the, we need to figure out, we're happy to turn on receive, because who doesn't like getting the money faster? We're trying to figure out the value of send and have some apprehension on, is it becoming a cost center? What does it mean for fraud? And is this going to cause a massive outflow of deposits, from the bank, right? And I would say, some of those apprehensions are well placed because, the first is, yes, it will become a cost center, except you might not gain new customers because they're like, oh, I'm going to go move banks because it has FedNow. They don't, your customer doesn't even know what that means. But you will actually, in the not too distant future, begin to lose customers when they say, hey, there's this functionality that I can either get paid faster or it does some other valuable thing for me because it is an instant payment that I want that to be enabled, right? The use case I love that US Bank rolled out is around car dealerships, right? And using RTP in the background. What a painful process, that is broken, which is I've got the car. If I didn't show up with anything other than a cashier's payment, right? I'm sitting there waiting for payments, to move around before I get title to the car. It's actually the reason I paid for my wife's car on a credit card. Thank you, Amex. A lot of points too. And willing to take the financing charge merely because I didn't want to have to sit in a dealership while I was waiting for a wire to arrive, right? Or leave the dealership and come back, right? Really interesting, valuable use case that I could say, hey, that kind of use case, US Bank might win customers, especially those auto dealerships. And so I think we do need to figure out how do we as institutions accrue value here? Now, I would push back on the fraud being an argument, which is I don't care what rail it is, including if you want to do anything other than going back to a cash-based system, banks need to get better at fraud management.
Okay, Aaron, he literally opened the door for you, right? We're going to jump into this for a minute. We're going to go back to your waiter, right? In terms of you spending the next couple of days making sure that you didn't send money to who knows where, right? Is faster payments and any platform, but is faster payments going to lead to more fraud or deposit losses? How are you seeing that evolution play out sort of behind the scenes?
I mean, I think to Jason's point, fraud is up no matter what across rails, right? And I think that for as quickly as we put out a new rail, as quickly as we put out a new service, the fraudsters have figured out how to, intercept and do things there. So, I mean, from the perspective of instant payments makes fraud more palpable in the sense that it's increasing volume, it's faster, it gives you less opportunity to sort of intervene on the financial institution side, less sort of time to see, what might be going on in the background. There's a lot. And as you've seen even if you kind of go outside of and just look at what we were talking about with payment mechanisms as a whole in the rails, I mean, it's incredible the volume that is occurring in unauthorized transactions, and it's clearly a big problem how much fraud there is. I do not think that FedNow exasperates that in any way. It exists. It doesn't lessen it. I think it's just it just is, and it's something, to Jason's point, that you have to have strong AML programs, strong customer due diligence programs, understand your obligations around error resolution and when you need to be there from a customer perspective on the financial institution side. But I think and this kind of goes back a couple of questions, but it touches on this as well. I think it's a trust factor to some extent. It's ACH, just to use an example, has been around for a very long time, and people have gotten comfortable. Commercial entities, to Jason's point, in the car dealership, right? I mean, it's a known quantity and people sort of understand it. Educating people on FedNow and that it's also safe and that it has the same things, I think, is going to be important to build that trust factor as the other rails. But I just think that fraud is an issue on all payment rails, and I don't see a change with FedNow other than it's another payment rail where it's going to be potentially, right, if it does what Tim wants, or what we all want, but what Tim was talking about earlier, and the volume explodes, it's just more volume. And we know from some regulatory actions we know. So from court cases, there are some limits as to what you can do as a financial institution when it comes to automating your ability to kind of look at that error resolution. And that can just create significant operational challenges in trying to parse through payments that are moving very, very quickly, instantaneous, high volumes. It's just going to be a matter of, getting that figured out, but it's no different in my mind.
Well, Tim, I'm gonna come back to you with that exactly.
Yeah.
I think that what Aaron said was that it doesn't make it any worse. Some could argue it actually makes it better, right? Competition breeds excellence, right? You now are creating mechanisms or sort of checks on various systems. Like, how do you guys think about it?
I was just gonna say that exact same thing, Phil. So I think there is an opportunity where fraud could actually be reduced by migrating it to an instant payment channel, right? So we're spending a lot of time. Financial institutions are partnering with some brilliant organizations that are adding artificial intelligence capabilities. If you can start to migrate volumes, let's say from a check channel over to an instant payments channel, where now there's some due diligence that's being done on the front end, as well as some anomaly detections and things like that before customer is hitting the send button and they're given advice on which payment rail potentially to use. I think there's opportunities to reduce the fraud risk for some of these financial institutions.
I just say the award for the politest panelist goes to Jason. He's always so polite, raising his hand to ask a question. Yes, Jason, please.
Well, that's because when we moved to Chicago, everyone thought I was a New Yorker, having come, from the East Coast, despite being a Midwestern farm boy. So I'm very... All right. In order to accomplish what Tim, said, which I do agree with, we need to see some fundamental rethinking around the data that are just being dropped on the cutting room floor today. We're not taking full advantage of it. We're not working across networks, across institutions. And this either has to happen at the institutional level, it has to happen at the the core level or the other providers that FedNow and RTP are partnering with, right? Like, there needs to be a rethinking on both the business model and the utilization of those data in new and richer ways. Because who's really good at cooperating, it turns out? Fraudsters. Like, they're amazing at their level. They might be in competition, but they still find a way to cooperate to fleece people better until you leverage technology to leverage data in that extraction.
Yeah, and it's it makes me think about, we all probably are aware of stories where any time somebody goes out and says, "I dare you to break my code," somebody's going to break the code. It's sort of inevitable, and I think that's where strong compliance management systems come into play. You can do as much as you possibly can to try and use algorithms and artificial intelligence. To Jason's point, the fraudsters are too, and some could argue are probably better at it, and they're going to break the code when you say, "I dare you to break the code," especially when there's this much money that's there. And so it really just comes back to practicing, taking what are traditional safety and soundness and compliance systems and modernizing them into this world. And look, this isn't new, right? I mean, Reg E has been around forever, and Reg E is an extremely consumer-friendly regulation where, the default oftentimes is it's unauthorized, right? I mean, I think banks are already comfortable with the idea that there's going to be, that kind of concept. This is just increasing the volume, and it's going faster, and that can create those operational challenges on the back end. But I don't know that any of this is a new problem. It's just the modernization of a problem that's been around forever. Don't write your debit card on the back of, or your PIN number on the back of your debit card kind of concept. But Reg E says that negligence isn't a defense. So if a consumer does write their PIN number on the back of the debit card, right? I mean, these are age-old concepts that are just, I think that it's really back to the compliance management systems and the AML, BSA programs to try and tighten up as much as they can, and just accept the fact that there's going to be some level of that that's probably inevitable and always has been.
So this is an AFC webinar. So Aaron, I'm staying with you. And because it's an AFC webinar, I have to ask, is there a regulatory modernization? And I'm sorry, because I'm taking us, sort of a little bit of a different direction. Is there a regulatory change that you think needs to happen or could happen or should happen, or maybe shouldn't happen, right? In order to fix the system, make it more consumer friendly, or at least make consumer feel like they're more protected?
Yeah, I mean, look, we do a session at one of our conferences every year that's kind of old laws, new technology, right? I mean, you have a lot of consumer regulation that could not possibly have contemplated where payments have gone, where lending have gone. You name the area of technology, it's moving faster than the regs necessarily did. And to the extent that there have been some FAQs that FAQs because they didn't modify Reg E, which I think plenty of us would argue maybe did modify Reg E. But in any event, some attempts to bring in payment providers and kind of the Venmos and what you were talking about earlier, Phil. But yeah, I mean, Reg E is old. Reg E hasn't really kept up with where things are going, how things operate. So it's difficult to sometimes take these creative and innovative products on the payment side and any level and try to fit it within these regs that were written at a time that just didn't contemplate the activities or how quickly it was going to go. And, you see that in what is a reasonable investigation, and can you use artificial intelligence in a reasonable investigation on the back end? Can you do some of the things that Tim was talking about? Will the regulators be comfortable if you're utilizing artificial intelligence, if you're utilizing algorithms to help do some of these things? Because the current regs really wouldn't give you the flexibility to do some of that. And without that, you're still stuck in this world of being a little bit conservative on the banking side, which I don't even necessarily think is a bad thing. It's good from a consumer perspective. It's good to bring security into the payments ecosystem, but it can be very, very difficult as you're operationally for the banks when you have the amount of volume that you're talking about and no real strong modernized guidance to deal with that.
I'll let either of you respond or weigh in on that or not. I'll leave it to you for a moment.
Oh, I've got to throw in one of my favorite tidbits was talking to former state bank regulator who was explaining that in the early days of crypto, the only regulation they had on the books that was near close to how to approach it was the transport of private currencies via steamship, meaning it had to, not be fiat and also of such quantity that it could pose risk, right? And so that's what they were left with, and it had never actually been taken off the books. But to this modernization piece of it, I think Aaron brings up a really good point on, there are things that regulation hasn't caught up with that are preventing us from defending the public good. And where we do need to remember, we are supposed to also think from a, principles first basis, how do we protect these customers? And sometimes that means wading into AI before we think we're ready for it and it's fully pinned down, right? The fraudsters are already using it. They're already doing a fantastic job of manipulating voices and creating images, right? They're really good at using all sorts of behavioral psychology to get people in the panic state or, to fall for the love scams. There's all sorts of tools at their disposal. They're using an amazing job. And us being afraid of misstepping on regulation is frankly lazy and does a disservice. Might keep our noses clean, say we can look to the regulator and say, oh, we didn't want to do anything dangerous. It's like, well, you're letting somebody else pay the price for that.
Great. Thank you very, very much for that. We'll switch it up just a bit in terms of mass acceptance or growth of FedNow specifically. Tim, you mentioned earlier, while growth is, excuse me, the number of the banks who have adopted the program is growing very rapidly. Usage maybe or volume maybe is still a bit low, or it's now starting. You're starting to see it on the move as vendors pick it up. What are the next steps for that? How do you see that increasing? Do you think that your current user base is going to start to sort of get more comfortable, or do you think you're going to continue to grow the user base?
I think it's both. Yeah, I think there's, this comfort level where, as banks that are on the network become more than just receive banks, they become send banks. They start to communicate out to their customer base, the value propositions associated with instant payments. So I think by nature, we're just going to see general comfort from bank end customers to start utilizing the capabilities a bit more. And then, this ongoing growth, right? There's 9,000 plus financial institutions in the country. It's going to take a little time, right? We're not looking to onboard these institutions within, the next 6-7 months. So we know that there's a long tail out there, and it's going to be a little bit of a slog when we get near the end, and our pipeline starts to look a little bit more challenging. But right now, it's all looking great, and we have a lot of promise now with usage. So it's looking up.
So let me ask you, what are the use cases for FedNow? Tell me, and again, for banks that are gonna hear this, sort of where are your current users seeing the most benefit, and where they see the most future benefit?
Yeah, I would say right now, wallets, digital wallets are popular, whether it's a merchant wallet, a brokerage type of wallet. So defunding those wallets are probably a little bit more popular, moving monies back to a bank or a credit union DDA. Online marketplaces and seller payouts are interesting and popular right now too. So we're seeing some uptake there. Government payments, which I think maybe separates us a little bit from RTP. I could be wrong, and I shouldn't state that, but we're seeing a bit more around the state and large municipality level with charitable giving programs, social welfare programs, things like that, bridges, tolls, account top-offs, really interesting stuff. And then real estate property management payments are also pretty popular right now, moving funds from rentor to property owner is kind of a big thing. There are certain areas around employer and employee relationships. Everybody hears about payroll obligations. I wouldn't say payroll in general is in the sweet spot, but certainly areas around payroll, like emergency payroll or terminations in some states, expense reimbursements, one-time payments for recruiting or retention, things like that are all kind of in scope here as well. So I only see that really kind of picking up a lot more. We've had discussions about where else could we go, with a lot of usage, and really the sky's the limit. We're very use case agnostic on the FedNow network, so we're not throttling where uses can go. But I think once we get some pretty smart organizations out there using the network and really kind of challenging where it wants to go, I don't think there's a limit.
Jason, you said something interesting, right? Sometimes it's the functionality, and then it's sometimes sort of the way in which the bank implements it or builds on top of it. Can you speak to that in terms of like real life, in terms of how the banks think about it and how your members think about it?
Yeah, so building on that discussion of how do I keep it out of a cost center, how do I avoid the fraud piece of it, and how do I manage the other obligations around it, like especially related to, is this going to cause an SVB style collapse? I think that teed you up for that one. I'll say this, that how the banks need to be thinking about it isn't just payments, but it all has to come back to customer first. What problem does this solve? We do the Clayton Christensen pains, gains, jobs to be done methodology all the time. What pain am I alleviating? What gain am I providing? And what is the job I'm hiring this payment rail to do that another payment rail can't do for me. And all of that comes back to some of the experiences. So I mentioned the timing based portion of it for cars. And I think it isn't just car payment. If you think of the settlement process as it relates to that other large purchase, a house, right? In other places where there is an exchange and, you have an intermediary like the title company involved while
Check.
you're all sitting there
writing checks. I had to go to
writing
the bank
check,
to
sign
get
here,
checks.
you sign there, now let's sit here, right? Oh, what is the function that can be solved? Well, smart contracts, dare I say, blockchain could be used here to say, hey, if Aaron has signed this and then Jason has signed that, and an instant payment satisfies as kind of the final signature, right? Like we don't need intermediaries anymore. It all becomes electronic. And it's a better use case for everyone except for the person who works at the title company. Those are the sorts of things that I think can be built out that will take a lot more friction out of the economy. Cross-border payments, another great example. If it's something that is unhedged and there's a time-based element attached, to this, by the time I send you the invoice and there's a fluctuation in the currency, who owns that change in the fluctuation? And on the back end, there's this reconciliation because none of my payments match the invoices that went out, like none of them, right? And whole business was built around this very successfully on student tuition, right? Something never occurred to me not being an international student. What a big problem that is. So I think that's where we're going to keep finding the more interesting use cases where there's lagginess or the multi-party aspect of it for large sums of money.
Aaron, I mean, that has to scare you on some level, right? Because there's like literally 6 things in what Jason just said. There were trigger warnings for me in terms of sort of thinking through the challenges and the solution. When you start thinking about cross-border and you start thinking about sort of expanded use cases, does that not scare you in terms of the work that you do every day?
Well, I am nothing but selfish, so having an international student, I would love that. But taking my selfish hat off, yeah, right. I mean, I think a couple of things that Jason said are, wonderful potential use cases, but that balance that we talked about earlier of where's the best use cases for it, where are consumers going to utilize it, and the extremely high potential for loss and fraud on the other side is really where that sticking point comes in trying to figure out exactly where and who holds the bag on a instant transfer $250,000 house, $500,000 house. As a that becomes scary from the fraud perspective for sure. International, despite my selfish desire for a quicker way to get money over there, again, just sort of it all comes back in a lot of ways to the customer due diligence and the fraud, and how do you do that in a way where you can feel comfortable from the bank's perspective and keep the consumer safe, right? It's both sides of the coin. You want the consumer to feel safe in using their money, but you also want the bank to not have a collapse because they have 3 house deals in a day go south and they're out $4 million. So it's a balance in trying to figure out how to really get stuff out there to drive the fraud down. To Tim's point earlier, I agree, and it'll be interesting. I'm not aware of anything that shows that there has been a decrease in fraud yet. But it's back to my point earlier of sort of over time gaining trust. If we can see a mechanism where fraud is going down because there's tools in place, there's functionality in place that's allowing the fraud to go down, then the openness to take that into a larger use case becomes that much easier to stomach, both on the consumer side and on the FI side. And I think that's where people sometimes can get a little bit lost in this argument. It's keeping the consumer, right? I don't want to be out that money, and I want to make sure that I'm safe when I send my money somewhere. And we have to keep the financial institutions going and not be on the hook when it goes wrong if they've done everything that is correct? And where do you place the actual liability at the end of the day if I did my customer due diligence and I have fraud in place and I've monitored my accounts and I've done everything I could possibly think of, but some really smart fraudster out there broke into the algorithm and got a hold of it? Where does that sit at the end of the day? How does that sort of work? Is the balance that on all of these instant payment rails, really?
So I hate to end on that note, because that was just an awful note, Aaron. Very good point, but just Tim, give us some optimism here. Obviously, it's growing because people are want it, right? People want it. Consumers want it. Banks want it. They want to be competitive with their other banks. They want to be competitive with the latest and greatest fintech companies, right? They want to be competitive, and so sort of tell us sort of, I would say in the closing words, just in terms of why there should be more optimism outside of what already exists.
Yeah, no, I think user demand. We're all conditioned now, right, to get immediate satisfaction, right? Whether you're streaming services off of Netflix or Hulu or whatever it is, I think we're finding that financial services is kind of following suit there, and increasing optionality, improving the customer experience, making it simple, keeping it simple. And then, to Aaron and Jason's point, keeping it safe and secure is really kind of job one, right? And I don't think there's a financial institution out there that's looking to increase its risk exposure, its risk profiles. So, they're doing everything they can do to partner with the right fraud mitigants out there that can limit that. So I'm excited about it because I think it's just going to go up, and we're going to find tools that are going to help us contain some of that fraud risk as well.
Well, thank you, Tim. Thank you to you and to Mark and to the entire team at FedNow. And of course, Jason, I know you're seeing and working with this literally in the trenches every single day with your members. And Aaron, you're trying to keep Jason's members out of trouble. To our great friends at McGlinchey and to everybody who joined today, thank you so much for your time. And we look forward to seeing you at the next one.